most of your listeners on a daily basis are driving by a property that's an opportunity. There is really a lot of opportunity in retail. And this perception in the general public that Amazon's going to kill retail is false. Retail's not going anywhere.
Welcome to the 0 to 100 podcast. Today, our guest, Ray Bayat, who I am thankful to call a personal friend, accomplished real estate professional and devoted family man. Ray's the co-founder of NetCo Investments, along with his brother, Mitch Bayat. Ray stands as a prominent figure in the shopping center industry. Since 2002, Ray has played a crucial role in the acquisition, redevelopment, sale, and financing over 1.3 million square feet of property, with transactions valued at over 346 million. Ray, welcome to the 0 to 100 podcast, Joe.
Appreciate you guys having me. Thank you.
Absolutely. So let's back up to what you were doing before. I mean, I've read a longer bio. I know your story personally, but I'm just curious. We always like to go back. When you were a kid, what was your mindset like? What did you think you were going to be doing, and how'd you end up to where you're at today?
So when I reflect back, the first memory I have of sort of my entrepreneurial spirit was 7th grade. I would buy bulk candy and sell it in school.
I knew a guy that did that. That's brilliant.
I did the same thing.
I did it with gum.
Yeah.
Because you can get the big things of gum. Yeah, this is amazing.
Yeah, Kit Kat, Snickers, Twix. That was, I would buy in bulk and sell individual pieces to the kids in school. And that's really my first reflection back on sort of an entrepreneurial spirit.
Isn't that funny how we're all wired like that? We're all most entrepreneurs that I've met have done something similar to, I went and bought the bulk at Costco. I had my mom buy the bulk of gummy bears, and then I'd put them into separate little baggies, and sell them for a crazy profit. Great. And then you blow it. Of course, you don't learn how to invest it and build generational wealth. At least I didn't when I was in the 5th grade. But
well, certainly, I think it all depends on your parents. My parents were wonderful people. They did the best they could, but they were really good in terms of coaching me or guiding me in that aspect. And that's really the only reflection I have of any entrepreneurial sort of spirit at a young age. And I went to undergrad and I got my ass handed to me, and I changed majors 5 times. And my last class, I got a C-, and I had to go meet with the professor to beg her to change my grade to a C so I could graduate with a 2.0. I was really clueless, just didn't know what I wanted to do and where I wanted to go in life. And then a cousin of mine handed me, and I'm old enough, you guys are all way too young, but in the old days, we used to have audio tapes. And so,
I've heard of those.
Tapes,
yeah.
Earl Nightingale and Robert Schuller and so on. And I started listening into personal development while I was driving. And that really kicked off everything in my life. I started focusing on just being a sponge, reading, attending classes, seminars. And that was really the kickoff to my interest in business and real estate and so on.
Real quick, Ray, on those audio tapes, I'm assuming you still listen to podcasts. I mean, I wasn't quite audio tapes. I'm a little older than these guys. I know I don't look it, but I am. I was really into the CDs,
Travis was listening to eight tracks and stuff.
Right. No. But I have a genuine, and I'm sorry to interrupt you, and I'll let you get back to your story because it's fascinating. But I just had a thought, in your mind, you've been listening to audio tapes and it probably went to CDs, and then it's been, then obviously we're into podcasts and things like that. Does the knowledge get regurgitated? Are you hearing the same thing that some of those earlier guys spoke about? Or is it you're always pulling out new nuggets? Because you think of books like The Richest Man in Babylon and stuff, which I think we all kind of grew up on. It's very similar concepts to how to entrepreneurialism and investing and, multiplying wealth. And I'm just curious, for those early guys that you're listening to, has the message been fairly consistent throughout the ages?
It is, but the fascinating thing, and there was a conversation on a thread yesterday, depending on where you are in your journey and what part in life you are, you could hear the same message, but it means something else. It's just like reading a book, right? you could read it today, and one particular story within the book resonates with you now. 2 years from now, it's going to be something else. So to answer your question, it could be that they're regurgitating the same thing, and it's also very different as well. But it depends on where you are in life, right?
Right.
So my interests have also changed. So like I'm listening to a lot more podcasts about leadership, about parenting, about marriage. 20 years ago, I didn't listen to any of that. As you evolve and change in life, your interests change. And so you're listening to different material now.
Were you a Kiyosaki guy? Were you into Robert Kiyosaki's doctrine?
I read Rich Dad Poor Dad, but that was really the extent of it. I don't listen to his audio or podcasts or anything like that.
So right. So you went from, you're in college, you're listening to cassette tapes, on personal development. How did that transition into the real estate world? How did you get into buying, million plus square footage of commercial property?
So I started by just trying to get my feet wet, and I started managing little strip centers and leasing them as third-party work, and got my feet wet that way. I mean, these are 1,000 square foot leases with the mom and pop tenants and managing them, and I learned a lot about the business. And then I started attending a lot of different shopping center events. In the shopping industry, the biggest sort of industry event is called International Council of Shopping Centers. And you can actually join as a student for free and attend a lot of these functions. And so I started attending that. UCLA, when I lived in Southern California, had on an annual basis one all-day event geared towards shopping centers.
So just for context, what years were these?
This was 91, 92. And so particularly in the National Council of Shopping Centers, I made some connections. I started learning more. And what I discovered, as opposed to apartments or industrial or office, product type of retail, what I found really interesting about it is the relationships. If you do a one lease with one regional or national tenant, and the transaction goes smoothly and you build trust, it's very likely that you'll do multiple deals with them. And I really like that aspect of it because that speaks to my nature. I'm not a transactional guy. I'm more a relationship based guy. And so I just saw that as a fascinating way to grow the business and do multiple deals with the same tenants and various properties.
Yeah, I love hearing you say that. We talk a lot with the 0 to 100 tribe about relationships being so important. I mean, that's how I've built my business. The transactional, I'm sure you can agree, the transactional piece of real estate is actually kind of the easy piece. Like there's definitely a transactional piece to real estate, but put so much more emphasis on building genuine relationships. I mean, I know you personally, you're definitely a relationship person, and that's something I can definitely appreciate. I know Travis and Mitch can as well.
Well, yeah. I mean, I think the nature of transactional, there's so much more friction in a deal if there's not that mutual trust and history. And so I love that you said it's like actually kind of a hack. It actually makes things a lot easier because people they know you, they know how you operate, they know you're a man of integrity, and the deals go so much smoother that way. So it reduces a significant amount of friction.
100% agree, particularly if you're in the shopping center world, because you're running across the same people. Everyone, all the tenants speak to each other. The Starbucks rep does talk to the Ross Dress for Less rep, and your reputation precedes you. And so if you're doing transactions with any of these national tenants, the word spreads quickly. It's really a wonderful environment to be in. And just like you guys talk about on your podcast, it's how you make people feel when the transaction is done, right? They want to do business with you based upon how you make them feel. And so there's always going to be negotiations. There's always going to be some challenges in a lease transaction or a sale transaction, but it's how you deal with it and how you overcome those challenges and how people feel when they walk away from you. And so I felt like the shopping center industry offered that, and that spoke to me. And so I transitioned, just going back to how I got into the business, taking the strip center leasing and management. And I wanted to get into grad school in Southern California at the time in 1993. USC had a master's program, a master's of real estate development. And it was only one of like maybe a handful of universities in the country that offered that. And on top of that, I wanted to do a dual master's with getting my MBA. And I'll tell you a quick story. So I didn't have the grades, obviously. And I took the GMAT, didn't do well. I applied early and they denied and said, look, your GMAT score is too low. Why don't you take it again and see what can reevaluate? And I essentially went all in, took Kaplan, studied my ass off, but it didn't improve my grades much, my score. And a week before the semester was to start, I went into the offices of admissions and essentially negotiated my way into admissions at USC.
I love it.
Under the condition that I'm on probation, and the first semester I had to get a 3.0.
How'd you do?
Which I did. And I studied actually a lot less in grad school than I did undergrad because I was just a sponge. I was sitting in the front. Everything that they talked about just sunk in. I loved it. I was passionate about it. I wanted to learn everything about business. So it was just so easy for me to do that. And then subsequent to that, I went to work for Newhall Land and Farming Company, which is a master planner of the city of Valencia in northern Los Angeles. They own thousands of acres, and they're still to this day, they're still master planning the entire area. So I was there. I've learned a lot about the master planning community, worked on mostly shopping centers, but some office buildings as well. And then transitioned into brokerage at Grubb & Ellis, which at that time was the second largest commercial real estate brokerage company behind CBRE. I'll never forget this. My manager there was an amazing mentor. Thad Seligman, I'm still in touch with them. And I interviewed with him and I said, eventually I want to go off and be on my own developer investor. And he said, well, I encourage you to look for your first deal first day. And so I was working like 100-hour weeks, and just very, very persistent and determined to succeed. And Thad really did an amazing job of mentoring me and teaching me a lot about the brokerage business. And then eventually from there, I transitioned into becoming a principal with buying my first deal in 2002.
What was that first deal in 2002?
So we put a vacant former Lucky's in Southern California, or California. It was a grocery store chain called Lucky's. And Albertsons ended up buying them. So we put a 60,000 square foot vacant building under contract. And again, this is, I'll tell you a quick story about this and why I think it's good for your audience. My brother and I, as partners, we didn't have a lot of money. And when you're trying to buy surplus real estate from one of these national publicly held companies, a lot of the individuals that work in the real estate departments do not want to take any risk with any unknown buyers because they're just afraid that my brother and I weren't going to be able to pull it off. And so I insisted on flying out to Phoenix, where the gentleman, Martin Leon, was handling the surplus real estate, and had a face-to-face with him and convinced him that I will get it done. We'll get to the finish line and close. I think that was critical in convincing Martin to put his neck on the line, frankly, with two young guys who didn't have a lot of money and experience.
Ray, how much of that was, I'm just picturing like younger Ray, you're flying to Phoenix, you have a face-to-face with this guy, you tell him your confidence, you're confident you're going to close. You haven't closed the deal yet.
Nope.
How confident were you? Were you like, I'm going to tell him that I'm going to close this deal and then I'm going to figure it out? And it was kind of this like, oh shit, I better figure it out. Or were you like real confident in yourself that, yeah, I have the experience and I have the ability to close it?
I was actually very confident. Two reasons. One, I think it's always helpful to have a partner. So my brother was with me, and between us, we could scramble. And, I had certain skill sets that I could focus on, and so did he. So I think that's always really important when you have someone to support you. And secondly, just because of all the experiences I had as a broker, and I'd done a lot of transactions, sold $100 million worth of land, worked with other developers. And one of the things that I did as a broker that most brokers don't do when they sell land, I insisted on attending all of the meetings with the architects and with the city. So I learned a lot about the development process, how to get projects approved, how to negotiate entitlements, what kind of architect you need to hire. I mean, I learned a ton as a broker. So I was extremely confident. And I think that confidence came across, and that's why Martin Leon chose me. And I mentioned these names, Bagzelum and Martin Leon, because I think one of the key things in my career is I'm very loyal. And to people who really take chances on me and teach me and mentor me or have guided me in my career, I stay in touch with them, and I'm always great friendships. And I think that's one of the key things is you really got to look out for people who look out for you. So anyways, so Martin Leon agreed to sell the property to us. And so it was 100% vacant. We put it under contract. By the time we closed, we actually had it 100% leased to 3 national regional tenants on long-term leases. Every single lease was 10 years.
I love that you came from the broker world. I love that you're a sponge for knowledge. I love that you're talking about friendships. You didn't just say relationships, you said friendships, which I believe is really, I keyed in on that because I think that's really important. And, you talk to people that are, I'm in my 40s, 50s, 60s. They've been investing for a long time. These are like genuine, true friendships that they've built. And so like, my question to you is, you had it leased up before you closed. I'm sure that was some part of the message you conveyed to them when you were convincing them to sell you the property. Did you already have those in the bag, or did you like have to go out and then start knocking on doors, but then leveraging the friendships and relationships you had built previously in the broker world? I'm just speculating here, but is that what happened?
Yeah. We had one lead tenant that was 99-cent only stores in Southern California. And unfortunately, they just filed bankruptcy and are liquidating the company. We had a lead with them, but the other 2 tenants, Big Five Sporting Goods and Factory to You, we actually hustled. And Factory to You was our last tenant, and they kept declining and saying they're not interested. And their headquarters at that time were in San Diego. And my brother and I drove down to San Diego and insisted on a face-to-face meeting, and we hashed out a deal there and got them to agree.
What a concept, face-to-face. What a weird concept these days. Like just sit down in a room.
I know.
Shake hands.
I love that.
It is crazy that that's like a rare quality these days.
Right. I think sometimes going back to like old school ways of doing business, handwritten letters, face-to-face meetings, like that surprises people. But people, we're humans and we're social creatures. And I think that goes a long way. So if you don't take anything from this podcast, get in the room with somebody, shake their hand, build friendships and relationships. So on this deal, Ray, you also had to convince the bank, right? You said you had no money. How did you finance it? How did you convince the bank to take a risk on a 100% vacant property with 2 young guys with no money? Like I'm assuming our audience are that's the other dot people are trying to connect in their head.
Yeah. So we hired LJ Melody to source the debt for us. So as we started, contacting these tenants and sort of developed some momentum, there were some letters of intent that were started to circulate. And so we just used that letter of intent. And actually, we were in lease with 99-cent only stores and provided that to LJ Melody as an intermediary. And they went out hunting for banks for loans. I remember LJ Melody telling me that they talked to 51 banks and they all turned us down because we're 2 young guys with no money and no experience. And one bank took a chance on us, but they insisted that it had to be 100% leased before we closed. And that's why it forced us to be in a position where we relented on some rents and some other terms, but we had to get Factory to You. So that's why we drove down to San Diego and convinced them to come to the finish line.
These leases that you signed, did these people know you didn't yet own the building or had debt lined up? And were they predicated on you closing on the building, or was it sort of like a hope and a prayer?
That's something you can't hide. You have to, it's full disclosure. That's your reputation on the line. And these are national, regional companies. You don't mess with that. Yeah, we disclosed, and the leases were all contingent on us closing on the property.
I want to know how they had no money. Where did the cash come from? I'm curious.
So we put in we put in 50 grand and then we raised the rest from investors. And we raised, I think it was over $900,000. And so through, basically friends and family investors. And then we secured the debt and closed on it. It was a construction loan. we built out the building, demised the space, got all 3 tenants in. And then once it was stable, we refied and kept the property actually and paid off the original lender.
So I'm curious, like, is this a model that like people, and I don't know a lot about this like asset class. So like, do people gravitate toward this model where they find this this vacant building, and then they're like, look, I'm going to put it in contract, maybe a longer time frame, go find tenants. And then like, by the time you're closed, like you've just created a lot of value out of nothing, right? Because like obviously an occupied building with good tenants is better than vacant. So is that a model that people use today, or is that something like, is that how you built your business? Or maybe talk about that, how that works.
So it is risky, obviously, right? Putting a building that's vacant under contract, hoping that you can end up leasing it. So there's several things. One, as time has gone on, that has become more and more difficult. The sellers are less inclined to give you time. The reason why Albertsons gave us a lot of time on that first deal was the building had been sitting vacant for 7 years.
Wow.
And so at one time, the retail market was extremely overbuilt and there was a lot of vacancy. Right now, we have the highest occupancy in the history of the United States in retail.
The highest occupancy, you said.
Highest occupancy.
Right now. See,
Right
if I
now.
were to guess, I would say it's not great because of COVID and all this. I don't know. I mean, this is, wow.
So it's the highest occupancy.
Okay, we're May 21st, 2024, highest occupancy in retail.
Yeah.
Amazing.
And a lot of the retail that you hear of, so Bed Bath Beyond files bankruptcy, all these other tenants. Right now, 99 Cent Only Stores has filed bankruptcy. They're going to close, I think, 300 and something stores. I can tell you the majority of them are already spoken for. There's a huge, huge lack of supply because since 2008, we were building less and less and less retail. And the existing inventory is either being repurposed. So you have some old malls that are being converted into corporate headquarters or medical campuses or whatever it may be. The mall business is very different than what I do. But in general, retail is there's less and less and less of it being built. A lot of the development was driven by Home Depot, Walmart, Target, Lowe's, and Kohl's. Because if you put a 25, 30 acre piece of land on a contract and you called up one of these guys and you got them, the rest of it was easy because everybody else would follow. Well, Home Depot and Lowe's and Walmart and Target aren't growing a lot. They're not opening a lot of stores. And so development has really, really been reduced over the last 14, 15, 16 years. And so we have a lot of occupancy. So to answer your question, the sellers are not giving a lot of time. So it's harder to find that scenario where you put a vacant building under contract and you try to get some leases done. The other thing is that I have done that multiple other times, actually. And it's all tied to the relationships I've built. So if, for example, one of your audience members is an apartment investor and they find an old Kmart that's vacant, they want to put it under contract. I think it would be very challenging for them to call and because they don't have a relationship with a lot of national or regional tenants and find those tenants and sign leases. Whereas for me, just because I've been doing this for so long, I know the head of real estate for a lot of the national retailers, or I have connections to them. And then I have the ability to pick up the phone and put the deal in front of them and speak the lingo and get the deal put together. So I've made it a career with my brother and I. So for example, in Inglewood, California, we put a property under contract. By the time we closed, we had a lease with Ross Dress for Less signed. And we did it again like a year later in Ontario, California. The most recent one that I did was in 2019. I put an old Mervyn's, if you guys remember Mervyn's department stores. Yeah. I put it under contract, and by the time I closed, I had a lease signed with Bayat Hispanic grocery stores, a 20-year lease. And there is a lot of debt funds right now in the marketplace that will provide 100% financing, 100% of cost, so long as your loan to value is 70% or less.
Fascinating.
So you can actually do a deal with no equity as long as the LTV is 70% or less.
So, with that, are they wanting a debt hurdle? They want a 1.25 debt service coverage ratio, or if it's vacant, is it a pro forma they're looking for, like a 1.25 or a 1.35?
Well, it's vacant, but they won't fund until the lease is signed.
Mhm.
And then they'll have some interest reserve, but they're looking at 70% or LTV or less. They're not looking at ratios and so on. There's actually a lot of debt funds and family offices around the country that are even willing to advance that kind of program for build-to-suits. So let's say you're a developer and you have a relationship with Starbucks and you put a piece of land under contract. They will fund 100% of cost so long as you're at 70% or 65%, some of them LTV. And so there's a lot of money and capital out there for those types of programs where you'll have to put in either no equity or very little equity. It's expensive. It's, 12, 14% interest, probably 3 to 4 points going in, maybe a point on the exit. But obviously debt is always cheaper than equity. So if you can pull that off and not put any equity in and create yourself some equity on the exit, that's the way to go.
So Ray, I'm curious about the process. I love the emphasis on relationships. We talk a lot about relationships. I can trace every single one of my deals back to a conversation or relationship. But I'm curious on the process too, right? Like I've bought some commercial property recently. It's been large industrial, and I'm basing the value of that property on the net operating income. I'm basing on, and granted, I'm doing my due diligence. I make sure it's a strong tenant with strong financials, and of course that the lease is strong. But I'm basing it on the numbers. Like, how do you? I guess a two-part question. How do you, put a value on the vacant piece of property prior to it being leased? And then even with the relationships you have, what's the first call you make? Who are you talking to? What do you like? How are you trying to get them, that particular tenant into that particular property? And then again, how do you value that property prior to a lease being signed?
Yeah. So having done this for so many years, I have a pretty good idea what rents tenants can pay. And so I really base the value of the property off of what rent I think I can achieve. And I've done it long enough to know, for example, if you're buying a vacant box, a junior anchor or anchor box, you can't really make the deal pencil if you're somewhere north of 70, $75 a foot. It just doesn't work unless you're, absolute infill, incredible densities of, let's say you have 500,000 people in 5 miles. Then the rents that the tenants can pay are significantly higher, and then you can pay more for the vacant building. But aside from just looking at vacant buildings, when I look at an existing shopping center and I'm looking to purchase it, because that's what we do as well. It's not just vacant buildings. There's 3 things I always look for. And I think one of the key things that somebody asked me, like, what do you attribute your success to is really the 3 criteria that I don't veer off. Number 1, I always have to buy a property below replacement cost. So that property that I mentioned, the Bayat property, I bought it at $50 a foot. If I were to go build that building, it would be like at that time, $125, $130 a foot. So I'm always buying below replacement cost. Number 2, I'm always looking for preferably below market rents, but even at market rents. I'm never buying anything that's significantly above market. I can tell you the majority of the people in my industry that got hurt and lost properties to foreclosure in 2008 were the ones that bought shopping centers with shop space that were paying $52, $60, $48 a foot annual rent. And in 2009 and 10, it crashed back down to 20. That could never get back up there. So I'm not buying anything like that. And the third thing is it always has to have some sort of a value add component. Because if everything goes, not according to plan, but if it's got a value add component, then I can just make that up. So for example, I bought a property in 2007 with an LA Fitness in it. And LA Fitness, the prior owner had no money to put up for tenant improvement allowance because LA Fitness usually asks for $80 to $100 a square foot in tenant improvement allowance. And so they, in exchange for that, they had given really low rent to LA Fitness. So LA Fitness had put their own money in it, but the bumps were significant. So in 5 years, I think the rent went, if I remember correctly, somewhere from $6 a foot to like 12. I buy this in 2007, and then, we go through the crash. And so if it were not for that, I would have been in deep trouble. But because the rent kept going up, and then in 2012, we sold it, the NOI had substantially increased because the rent had doubled for LA Fitness. So it has to have some sort of a value add component. So those three things: buy below replacement cost, below market rents, or at most at market rent, and then some sort of value add. So those three things have always been helpful. And when you look at a vacant building, it's the same thing, right? If I'm buying it at below replacement cost. Right now, I'm looking at a shopping center that got converted into office. Component of it is retail. I can turn it into retail if I want. It's $13 a square foot. If I were to go build that today, it would be 150 plus.
I mean, this stuff is just gold. I think the last couple of minutes, any listener needs to go back and like replay that 3, 4, 5 times. I mean, I love that you have very specific criteria. It's just fundamental investing. Like you're like, this is the 3 rules that I've created for it to make sense, and you stick to it, and you're successful doing that.
Yeah. And you got to, and that helps take the emotion out of it, right? You don't stretch. There's no emotion involved. If it hits that criteria, you're in. If it doesn't, you're out.
And by the way, these 3 principles don't just apply to retail. Like generally speaking, you can buy below replacement costs. I mean, you listen to Lindahl, he talks, and he's a multifamily guy. That was his thing, buy below replacement costs, below market rents or at market rents. I mean, we do that. We're in the manufactured housing community space, and value add. So what are some common value? Obviously, value add there was just the NOI improvements through the rent bumps over time. What's a common sort of like playbook value add that you're doing for these properties? Like, what are some examples?
Sure. So let me give you the example of one that we just a couple of years ago we bought it, and we're starting to execute on the business plan. The majority of the general population drives into a shopping center. They believe that every single one of those buildings in that shopping center is owned by the same group, one landlord. It's fractional ownership. So you'll see like McDonald's owns their own building, but Walgreens may be owned by a separate investor, and then the rest of the shopping center is owned by a third investor. So what we've done is looked at buying shopping centers where we could replat and then sell off the pieces individually. So if I buy a property and I sell it off, as one, I'm not going to extract the same value. I could, exit today on a shopping center, let's say at a 7.5 to 8 cap. But if I break it up into pieces, I can sell it off at a 5, 5.25, 5.5 cap. So that's a perfect example. About a month ago, we sold we bought a shopping center, replatted it, recorded title documents for declaration in terms of reciprocal access and easement and parking and all that. And then sold off the gas station convenience store for a 5 cap. And we got other components of it for sale. We got a Burger King that's for sale. We got a Lubbock breakfast restaurant for sale. So that's one way that we look to extract value.
I got a question. Why is that? Why do you sell the smaller parcels off at a higher cap rate? Maybe I'll answer my own question because there's a bigger buyer pool because it's less expensive. But also I see lower cap rate, larger properties like in apartment buildings and mobile home parks and et cetera. They're trading at lower caps because they're larger, because you're getting institutional buyers. So it just seems a little backwards to me.
There's a lot of single tenant buyers, what I call mailbox money, right? The group that bought that gas station convenience store, they own hundreds and hundreds of single tenant properties throughout the country. They don't want to do anything with management. They don't want to, maintain the common areas. They just want the once a month, the ACH hitting the bank account. So there's that buyer pool, and it's significant. Anything below $5 million, you have a huge amount of buyers.
Bigger buyer pool.
And so they're willing to pay, a huge buyer pool. They're unlevered. They're all cash. And so as a result of that, you have, ability to push the cap rates down. And so that's the reason we do it.
Got it. I was thinking it's a bigger buyer.
That's one, that's one value add component. Another is we can knock down some buildings, redesign the site plan. There's a variety of ways. You could actually buy out some tenants out of their leases. Maybe they're significantly below market, and you approach them, and if you're doing due diligence and you hear that their business is not very good, but they got 4 years left on the lease, and let's say they're at $10 annual rent, but the market's 20. You could certainly approach the tenant that they want out, right? And they have no idea that you want to add the value. And so maybe for a nominal amount, you can buy them out and they leave, and then you can bring in a new tenant. You could certainly upgrade the tenant profile, because the buyer pool likes to hear the national names. So if you have Joe's Coffee, but you can get rid of Joe's Coffee and put Starbucks, all of a sudden your cap rate just went down.
Cap compression.
So that's a value add component where you could change the tenant profile and tenant mix. There's a lot of various ways that you could really extract value out of shopping center.
Ray, how much weight does having a national tenant have with bringing in other national tenants? When you go to a potential tenant and say, "Hey, Starbucks is about to sign a lease here," how much weight does that hold for other national tenants to come into the same area?
A lot, especially depending on who the tenant is. For example, if you got Whole Foods, there's a lot of demand for retailers to be near a Whole Foods or a Starbucks. And even a Starbucks in an unanchored strip center, let's say 10,000 square feet, and you want to build a strip center, you start off with Starbucks and you put that on your leasing brochure, it makes the leasing of the rest of the center a lot easier.
This is so interesting. Like, I have right down the road from me, it's like I'm not in this industry, right, or this asset class, but like I'll drive by and I've stopped like 3 times at this like huge shopping center, huge strip mall. The whole thing's vacant. And I don't know why. It's right off the freeway. It's actually like in a healthy area. And I'm like peeking in the windows. Like, I'm not a serious buyer, but I'm like, how could I fix this problem? Anyway, I'm like taking I have copious notes right now from you.
You can just call me.
Hey, to be honest, like this whole call, I'm going like, okay, I gotta call Ray and at least show you what's going on here, because it's so strange. But I don't have the knowledge for that. Like I'm an MHP guy, right? And so, but I can just see like there's got to be opportunity for the right person in these vacant buildings.
There's a lot of opportunity. Most of your listeners on a daily basis are driving by a property that's an opportunity. There is really a lot of opportunity in retail. And as time goes on, but here's the also fascinating thing. And I went back and looked at some like headlines and some emails from 2019 where they had predicted that retail is going to be, dying because of Amazon. And then I just, 10 minutes ago told you that we've had the highest occupancy. If you look at the financial statements for Amazon has never once ever in the history of the company made money on retail. They lose money all the time. And they've tried their hand at brick and mortar. They bought Whole Foods and they haven't done well with it. They opened a whole bunch of grocery stores in Southern California, Illinois, and I think Pennsylvania and New York. They put a stop to it. They're not operating it well. They've tried various other retail concepts and they haven't done well. They make all their money from cloud services. And this perception about and the general public that Amazon's going to kill retail is false. We are highest occupancy. We have continuous new concepts coming out all the time. Retail is actually thriving. The grocery store is doing extremely well. Sprouts is growing. All the Hispanic grocery stores are growing. There's an Asian concept that's growing. The Aldi is growing. Walmart's still doing Walmart neighborhood centers. Here in Texas, HEB is booming. So that's really, in our world, that's the safest investment, is if you have a grocery anchored shopping center, because even in the depth of the recession, everyone's shopping, for groceries. And so that's why there's a premium for grocery anchored centers, and the institutional investors are really after grocery anchored shopping centers, and they get very competitive. And so retail is not going anywhere. It's a great asset class. And right now in the last year and a half, there's a lot of institutional capital now flowing into retail, buying strip centers, unanchored strip centers. Whereas before they always needed the 200,000 square foot shopping center with all the junior anchor boxes and the grocery anchored retail. But now they're starting to even look at unanchored strip.
Do you think this asset class is crowded? And what I mean by that is I know that we're in a lot of the same circles, which includes a lot of real estate investors. And I mean, I've spoke to hundreds, if not thousands of other real estate investors. And I know maybe a handful of, you probably know a lot more, but I know maybe a handful of people that are in retail, or at least doing it to the scale that you are. Do you think it's crowded? Do you think that people are just, they're fearful of it because of, say, Amazon, or they think it's too big for them to play in that arena? What's your take on that?
There's a lot of factors. One, I think, yes, the general consensus is Amazon's impacting retail without anyone really digging in and understanding it. But I also believe it's the most complex asset class. Doing industrial and self-storage and multifamily is relatively easy. And I'll tell you why I say that. Office is a little bit more complex. But in retail, there are so many nuances that could really turn a deal upside down. So for example, I'll give you an example. When we bought that Mervyn's in California, through the title documents, if you're buying a retail, you definitely got to pay attention to the title documents and read them thoroughly and be very knowledgeable about it and have a really good attorney and hopefully a really good real estate operator advising you. So one, we had to read the document that stated that if we're going to remodel this building, we had to get the adjacent owner's approval. And so we had to do due diligence as to who this person is. Can they hold up our entire project? And we read the language, the legalese that said basically that we have to send the information to them, and it listed everything that we had to provide. And then they had 30 days within which to respond. And if they didn't respond, it would be deemed approved. So we had to do a ton of homework on this group to make sure that they're going to cooperate. Because if they didn't, I don't know if I would have bought it. That's a lot of risk, right? Then you're stuck not being able to remodel the building. Second thing is it came with a vacant piece of land out front, what we call a vacant pad. And that we eventually built a Dutch Bros on and sold it, Dutch Bros Coffee. Well, this is from 1989, the title documents. And at that time, the buildings were the height limits in the title documents said it could only be 18 feet. Well, Dutch Bros wanted to be at 24, and the majority of QSRs these days are higher. And so we had to go through a very extensive process of getting the declaration amended and getting the height elevation increased. There's all these other complexities within the title documents as to who's going to manage the common areas. And if it's under a separate ownership, if that person doesn't do it and they default, what are the repercussions? What's your remedy? Because don't forget, if you own one component of the shopping center and another one is owned by someone else and they're not operating it well, and it's not well maintained, it's actually having an impact on your value, your leasability, and how you attract other tenants and customers to yours. So there's all this complexity. And then within the leases of the national tenants, they have what's called exclusives. So for example, if you have a Starbucks, you can't do another coffee. They have restrictions on what you can do with the common areas. So for example, if all of a sudden you want to build another building, they may block you out from that. And you got to read those leases very thoroughly to understand the implications. So I get offering memorandums all the time from brokers, and they slap on 2 pads out front and go, value add. You can build 2 pads out front. And my first question when I call them is, have you read the title documents? Is that permitted? Because a lot of times the title documents say there's a site plan that's attached to it, and they say you can't make modifications to the site plan. And a lot of times, believe it or not, silence.
This does not surprise us. I mean, this doesn't surprise, I don't think, many of us on here, many of us listening. I mean, it's to me, it's no different than the residential broker saying, hey, this is a great investment. And you're like, it's a cute house with a nice front porch. Doesn't make it a good investment, right?
Yeah. And it also just punctuates the need. And we talk about this all the time in the tribe, like, be really damn good in an asset class, right? Like, you've obviously picked your niche and you were very successful, right, in your asset class, and there's, we've, like, Gabe's been through different seasons with industrial triple net, mobile home parks before that, small multifamily before that, but like, know the nuances of your asset class. Like, I wouldn't have known that. Like, and I'm sure the brokers don't know that. They're like, great investment opportunity, value add, infill, like, well, and so understanding how a bank looks at it. I love the fact that you're saying, because being really, really hyper aware and very knowledgeable on your asset class, yes, it's going to help you not get your ass in trouble, like you're talking about, like you close on it. Now the entire value add plan's thrown in the trash because you can't do it, but it's also going to, by also being very knowledgeable in your asset class, it's going to help you like uncover opportunities that others cannot. That's the second piece. So there's a good side of that. Like, oh, most people don't know this, but I know I can do this. But also, the relationship piece, going back to that, like a property can be a vacant building is going to be a lot more valuable to you. Like, let's take this property Mitch is talking about. He drives by every day. That property is not nearly as valuable to Mitch as it is to you because you have the relationships to go fill it up. Mitch, nobody's going to answer the phone. I mean, then his mom probably doesn't even answer the phone when he calls him, let alone like somebody, a national department store. Like, nobody wants to talk to Mitch. Look at him. But I'm just saying, like, your relationships, oh yeah, no, I was gonna say your mom and I spoke. She doesn't. Oh, but I'm serious. Like, that's really interesting, and I love the fact that like you could go and like, oh, I know damn well I've got 3 tenants that would be perfect for this space. I know what they're gonna pay, but that's because you've been doing this for so long. I had a follow-on question before I get interrupted by Mitch. Are you a holder or are you a flipper, or do you like? It looks like you do a little bit of both. You sort of prune your asset, your portfolio. Like, tell us a little bit more about sort of your flip or your hold strategy and the long-term implications of that.
Yep. So number one thing that I look at is, have I maximized the value, and is there a downside risk in the future or still upside? So I'll give you a perfect example. Our first deal that we talked about earlier on, we refied and kept because we signed 3 leases with 3 national regional tenants. All the leases were in single-digit rents with options. Shortly after we closed, Home Depot announced that they're going across the street. They put a traffic signal into our property, which vastly improved, obviously, the access. The vacant lot next to us got built. And so we decided this is only going to get better. Our rents are really low. We'll just wait until all the options expire. And we'll keep it. Sure enough, 99 just vacated, is going to vacate because of bankruptcy. And we already have offers that are significantly higher rents. And so that's why we kept that. 100 yards down the street, we bought another property, a former Long's drugstore. In California, there was a chain called Long's Drugs, but CVS bought them, closed their stores. And then we put Ross Dress for Less in there, but we maximized rents. And we immediately sold it. So I think that's really the key thing that you got to look at. If you still got upside, keep it. If you've maxed out the value and there's downside risk in the future, get rid of it. That's what essentially we do.
Which again is probably can be applicable for all real estate assets.
Pretty much every asset class.
Yeah, that has me thinking about my entire portfolio. Which of these assets, there's no more value to pump out of it other than maybe the cash flow. But
don't forget what we also consider is not just the rents. Look, if the area is deteriorating, right? If you're losing population, and I'll give you a perfect example. We bought a shopping center in Illinois that I thought was going to be the best investment I've ever made. They're losing population. There's no job growth. There's no employers moving in the area. It is dying. Versus in Texas, the number of business formation, the number of people moving here, that can correct a lot of mistakes. And so those are things that you also got to look at about the area, the trade area, demographics. One of the key factors that you got to look at long term is the roadways, right? If you're on a major roadway and all of a sudden in the future, the Texas Department of Transportation is going to move and align the roads differently, and now the traffic doesn't flow in front of your storage facility or your shopping center where you need the cars to drive by. That's not good. You got to look at it and go, I'm out. So, there's a lot of factors you got to look at.
Micro and macro threats.
Yeah.
I think it's interesting what you said, though, about like once you push the property to maximum value, now technically holding it, you're risking your initial, down payment and capital, but also you're risking that equity by holding that. Anyway, it's just a different way of looking at it. But like, that's a really interesting, like you said that and like something just sort of like switched in my brain going like, okay, what about my own portfolio where like we have these mobile home parks that like we do force appreciate each year, but it's very slowly. And like, basically like we've already had our very fast moment in time that we added value, and going forward, it's just very slow.
Right. But you also the other factor is you got to look at the debt environment, right? That plays a factor into, if you're going to hold on to it, you're going to put a long-term debt on it. What's the rate? What does it look like? What's the environment? What's the leverage? All those factors.
That's a good question. I actually wrote that down as a question to ask you, Ray. Like, who are lending on these properties? Is it insurance? Is it agency debt? Is it credit unions and banks? What sort of long-term debt are you putting on these?
Yeah, there's no agency debt that I'm aware of on retail. It's predominantly life insurance companies.
Got it.
And then commercial mortgage-backed securities, but they're hit and miss. And I tried once to do it, and I walked away after about $45,000 in costs. I'm not a fan of CMBS loans. So the majority of my long-term debt is life insurance companies.
And are these typical, what kind of terms? Are these 25 and 5, 25 and 10?
A variety. I mean, life insurance companies have a huge variety of loan terms. Yeah, I mean, I've done 20-year fully amortizing. I've done 25-year fully amortizing. I've done, there's 3-year money, interest only for life insurance companies. I mean, there's all kinds of varieties. I use Northmark Capital as my intermediary. They've been very good in sourcing debt for me, and they're in front of a lot of national lenders.
That's key. Mitch and I were just talking about on the Elite Mastermind before this, where like getting a broker that knows how to place the right type of debt with the right type of property. They're going to take a fee. They're going to take a point. They're going to take origination fees, whatever that is. But it is so worth it. Like we found a great broker actually through Gabe's relationship. Again, this is a relationship game. Gabe introduced us to this broker, and he's like, "Oh, I know a great credit union for this, or I know a syndicator of actual bank funds for this particular property. And so, this isn't a 3-year interest only. This is a construction component. Then we'll do a takeout on the back end for X. But having a broker that helps shop debt for you, place the right type of debt, helps you negotiate with the bank, and then helps guide you through the underwriting process is absolutely key. Mitch and I made that mistake where we just settled on one bank, and this is our bank, and we're going to use this bank every time. Well, when the macro winds shift economically and all of a sudden that bank decides to stop lending, or they say yes, but no, because their terms are such crap, like having a broker that has their finger on the pulse, not just nationally, but also geographically and regionally is really, really important. So that's like the third time you've mentioned using a lender broker. And I think that's really key.
One last point on that. It's the more you do with that individual, the easier it becomes for that individual to sell you to their lenders. Because look, like Northmark has relationships with all of the national lenders, life companies, CMBS, banks, and so on. They will not put their neck on the line. They will not be an advocate for you unless you've closed. And if you close 1 or 2 or 3, all of a sudden, when they get the package from Northmark, the bank or the life insurance company is going to pick up the phone and ask them, "Hey, tell me about the sponsor." And if they're an advocate of yours and they say, "I'll close 12 loans with this group. I really believe in them. They've executed, they've exited, they've paid off every single loan." Boom. Right there, that credibility goes a long ways.
It's worth millions.
Because otherwise, if you're trying to find the lender yourself, they don't know you, right? Probably 75% of maybe even 90% of your first loan is not really the deal, the real estate. They're underwriting you.
Right. As an operator. Yeah. Well, and you've talked about group, you've talked about us and we. Tell me, and I know we're running out of time, but I have so many questions to ask you. So I'll try not to go too long here, but like one of the questions I have, I noticed that you on your website, you have run by EOS. One of our pillars in this tribe is operations. Do you have asset managers? Do you have a team? Is this just you and your brother? Like what does NetCo, your investment company, look like now from an operational standpoint? And how does that parlay into operating these assets? And how does that free you up to do whatever you do in your strengths?
Sure. So first of all, my brother passed away and I've been running the company since 2018. We have experts in leasing, experts in operations, finance, accounting, and we outsource some of our work. We outsource some of our due diligence. So it's a variety of different people. And again, I'm loyal, very loyal. I try to use the same people over and over. So for example, I fight tooth and nail to use the same Chicago title reps and escrow, because it just, again, it makes life very, very easy They know you. They have all of your documentation on file. I don't have to ask for everything because of, they know you. So by doing that, I leverage my time by using the same people in my circles over and over and over again.
And these aren't like W-2 employees. These are just professionals like you work with.
No, I do have W-2 employees. Yeah. But as well as the W-2, I outsource a lot as well. So it's a combination of all those things.
Got it.
I mean, look, retail, given the complexity of retail, it's not a one-man show. I mean, I've done the whole gamut, but you really need a whole team around you to do property management, asset management, finance and accounting. And, the thing of when people ask me, the one thing that I don't like about my business is how many documents I got to read. I mean, every single one of these national leases with like raw stress for less is like 130 pages, legal side. Every single loan document is, and I commented this and I actually put on LinkedIn. Honestly, for the years that I've been in the business, it seems like every year there's 2 to 4 pages added to every single loan document and every single lease. So it's complex. And so you need a whole, slew of teams, attorneys. And when it gets to construction, I got to have really experts in construction reviewing the landlord exhibit and what I'm responsible and how to build it and how to deliver it. So it is like, you have to have a team.
Wow. What's your current portfolio now? What are your holdings now look like, Ray?
You mean in terms of like total square footage?
Yeah. I mean, we talk about, assets under management or ownership, about a dollar value, square footage, like whatever's common for this specific asset class.
Honestly, I've never really paid attention. I see that a lot where guys come in and they put like on their LinkedIn profile, AUM, whatever, 100 million or whatever.
$1 billion.
It's like, no. Yeah, I don't really judge my self-worth or I'm not trying to prove anything to anybody because it's just not that important to me. So I think it's like 800,000 square feet is what we own. I don't even know the value of it, honestly. It's like I don't pay attention.
Translated to like shopping centers, is that like how many shopping centers would 800,000 square feet be?
So it's 8 of them.
Yeah, I'm glad you said that because you said 800,000 square feet. I'm like, I don't even know what that means. Yeah, it's just too much.
Actually, it isn't. Honestly, I'm very small compared to a lot of my peers in my industry, and so I'm not driven by I have to do a deal. I'm driven by it has to make very good economic sense for me to take the chances and the risks because I syndicate. I'm not going to put anybody's money at risk. And going to your earlier point, I know retail extremely well. I know everything about it, the ins and outs. So I'm comfortable raising money and doing retail because that's my niche. Can I do any other product type? Yes, but I wouldn't put other people's money at risk. I'd do that with mine.
I love that. And we talked to, our elites about that, where it's like, if you're going to ever raise capital, it's a fiduciary responsibility. You need to know that asset class, go really, really deep on that asset class.
Oftentimes do it on your own. If you can, do it on your own before you start taking money, prove it. Yeah. Well, that was actually a question I had. Do you JV? Do you syndicate? Sounds like you guys.
Yeah, I've syndicated before and I still do. I've JV'd before. I'm open to a variety of structures. We've talked to landowners. We've always bought existing shopping centers before, but we're starting to evaluate smaller developments. So we've talked to people with throwing their land in. I mean, once you know, really the name of the business in retail is if you know the tenants. That's really the key.
And the future is bright for retail in your opinion, right? Like is this like, hey, we got 10 years of a run, or like it's bright for the foreseeable future?
Yeah, it's foreseeable future. One of the factors that people forget is I think nearly 50% of this country lives paycheck to paycheck. So they get their paycheck on Friday and on Saturday and Sunday, they go shopping. They're not like the four of us here where we got a credit card and we go online and buy at Amazon, right? Or order something and it gets shipped to our house. The other factor is we're social animals. I don't care what people say. My wife loves going shopping. My daughter loves shopping. I like to go. So I was going on a big hiking trip with GoBundance several years ago. I'm so busy. I don't have patience to sit there and review product and, learn about it online. I just walked into REI. I found a guy, I forget what his name was. He spent 3 hours with me. The dude was so knowledgeable. Whatever he said, I bought. That's what I want. I want to walk in. I want someone that knows what they're doing and saying and help me make decisions rather quickly rather than me spending 25 hours online researching things.
That's a great point. People are people. Like, we like to do business with people. People are people. Like, people like to do business with people. People like that interaction. So when I go to the shop, when I go to the grocery store here, like, I don't want anybody to see me. I don't want to have a conversation because I'm kind of a hermit, but I'm weird that way. But like, most people want to get out and especially in their community, want to talk. How was your week? I love that perspective because I honestly would have thought, like, I think even in the book that we wrote, we talk about like macro shifts and asset classes and big box under attack and retail. What, Mitch?
We have to go change that now.
We'll write a second book.
Mindset.
Let's write a second book.
Right. We'll write a second edition. Mitch was wrong. Retail's fine. Ray's right. Ray, when we wrote that chapter, I told Mitch that's not true. I told him, but he doesn't listen to me.
But I don't want you to change. I don't want you to write a second book. I want you to continue to tell people that retail's dying because I don't want competition.
Right. Hey, everybody listen to this.
I like that.
See, don't listen to the rest of it.
I'm helping you out, man.
Retail's dead. By the way, you do have a comment. So we have some more comments in the live audience. I don't know if you can see the chat. We have Taryn. She's in the audience. She's got a perfect grocery store in downtown Lebanon available right now. She's an agent with an owner builder. So there's your phone number right there. Call Taryn. Go buy a grocery store. And then, you can get with Mitch to find out what's going on with that shop, that strip mall that's dead. I have one last question here and then we'll get in. I have two last questions, and Gabe or Mitch, you can ask the question that we ask people, not the one about who's better looking because we know that's me, but the one about
I thought we stopped. I thought we stopped with that.
We stopped that because it can't. Travis. It's obnoxious. But you also own a restaurant. I'm looking at your bio and 2 retail businesses. I mean, that was a long time ago, 88 to 94. But like, you're just an entrepreneur at heart, right? What were those? You don't have to get into the details because we're out of time. But I thought that was really interesting. You owned a restaurant. How was that?
It was a franchise Roundtable Pizza in Southern California. I owned that with my brother. Yeah. And I would not recommend the restaurant business for anybody. It was 7 days a week from 8 a.m. to 11 p.m. And the crazy stories I have, people walking out with our furniture, with our TV, people ordering extra large pizzas and, eating every slice, leaving one and coming back and saying, I didn't like it. It's a hard business.
With thin margins.
I also helped my brother. Yeah. And very small margins. Yeah. And way earlier, I helped my brother start a video store. Believe it or not, this is before really Blockbuster took off. And then we also owned a laundromat.
I'm interested in laundromats. I think those are compelling these days.
Yeah.
I've got one more. I really enjoy asking this question because some of the people in our audience are at zero properties, $0, haven't gotten started. So my question to you is, if you had to start over tomorrow, right? No money, no properties, you've got your contacts. Like, how do you go out and build what you've done, or build equity quickly and cash flow quickly? Like, what's your first move? And part of this is like kind of giving advice to these younger folks who are just getting started.
I wish somebody had told me this. I think the number one thing is a mentor in the business. I've come across several people in the last 10 years that are younger than me and have far exceeded in terms of their success in their portfolio, because it all started at 22 or 23, where they found a mentor in the business, in the shopping center business, and just shadowed them and learned everything that they were doing.
Also learn what not to do, like what not to do, and how not to lose money, and how not to waste a bunch of time. We talk about that too. Like, exactly. I love that. That's a really good answer. Find a mentor. That's the first.
Yeah. Yeah. I mean, I tell people all the time, the number one thing is like, you got to really qualify the seller. Like, you got to know, is this a motivated seller or not? Because one of the biggest lessons I learned is I put a shopping center in a contract. And I had to walk away. It was $75,000 of due diligence costs. And it came down to the seller was not motivated. And so when I discovered a whole slew of issues with the property, They told me to go pound sand. They weren't going to, work with me at all. And so I had to walk away. So yeah, it's those mistakes that you can avoid by shadowing someone who is extremely knowledgeable in the asset class and can guide you, and you can just pick up the wisdom from them from the years and years of experience.
Solid gold, man. Solid gold. How can people find you? I have some people asking how can they find Ray, or do you not want people to find you?
No, that's fine. I'd be happy to help anybody. Talking about EOS, we started EOS right after COVID hit. And collectively, my team and I have come up, and our core focus is really not related to shopping centers or real estate. It's really bring value to individual lives. That's what we stand for. So if people want to reach out, if I can bring value to them and help them, guide them along their path, of buying the vacant shopping center by Mitch's house, then I'd be happy to do that. I was
just going to define EOS. EOS stands for Entrepreneurial Operating System. Is it Gino Wickman and Traction? Also, I think a lot of that came out of Vernon Harnish, Scaling Up. So the books and big believer in that stuff. Really powerful. As you're building your teams, as you're building your businesses, like EOS is a really great way to structure your business. And I love that it's not real estate. I love that your core purpose is to provide value to people. That's a cool core value.
Honestly, that's the way I live my life. That's the way our team conducts business. It's how you make people feel when they walk away from interacting with you and doing business with you. And if you've added value to them, they continuously will look out for you, and you'll be top of mind.
All right. What's your how do we get a hold of you, Ray?
Yeah, my number is 972-867-1100, extension 23.
Yeah, Ray, thank you genuinely for being on. I know you had questions whether you were the right guest, but absolutely, I think that you brought a ton of value, a lot of gold nuggets, and I mean, I'm excited to go back and listen to this recording. So appreciate you very much.
I appreciate you guys very much. Thank you.